Hello, welcome to another strategy. Strategy number 4 of volume spread analysis (VSA). And make sure you bought the book, you read the book, Master the Markets mentioned in lesson 1, using our before using our trading strategy. And this strategy applies on gold, GBP USD, Euro USD, AUD USD, USD JPY, USD CAD, New Zealand USD, and sometime it applies on Bitcoin, oil as well. And the time frame you use is for the Asian session you use 1 minute, 5 minute. For UK session you use 5 minute and 15 minute. For US session you use 15 minute and 30 and H1. And skip any trade if stop loss goes above 50 pips, and ideally it should be 20 to 30 to 40 pips. Stop loss should not go above 50 pips. If any scenario hinting you or costing you more than 50 pips stop loss, then don't trade that. Trade those stop loss who are small, those trade setups who have a small stop loss. Okay. Again, we use the ExyTrader demo account on desktop, and on mobile we use ExyTrader broker to get this tick volume which we read in our trading strategy. And for trading view we use Oanda charts. Okay, so this is the gold chart, 30-minute chart of Oanda. And what's happening there, that market is to start slowly going up. Now market is dropping, and there is a ultra high volume on all candles. All this drop, market is dropping below, and there is a ultra high volume on all this drop. Okay, whether it is buy candle or sell candle. You saw ultra high volume on buy candle, ultra high volume on sell candle, ultra high volume on sell candle, ultra high volume on sell candle, ultra high volume on buy candle, ultra high volume, sell candle. You saw the ultra high volume on all this candle, this whole drop. Now you have to wait. Whenever you wait, you see if market ranging in low, if market start ranging like this consolidation small range, and market volume is dried in this range, then you just need to buy if that market breakouts. And when market breakouts, just check the volume. Check volume is low, just buy it. You should place stop loss below this low, and you should expect 1:3, 1:4, 1:5. That is the strategy. Okay, what happened there, that market was at this place, then suddenly any news came into the market, and market start dropping aggressively. And on this whole drop, on every candle the players were active, and mostly this was a drop, so players were actually buying in this drop. And when the NF bought this drop, then this drop actually stopped there by this stopping volume, and then market start ranging, confirming that the imbalance of supply and demand is established. And now market is shifting itself from selling to buying. And now wait for the breakout, low volume breakout of this range. Whenever market came out of this range with the normal low volume, just buy there, place stop loss below this range bound situation, and expect 1:2, 1:3 very easily. Again, market was going up. Gold, this is a gold chart, 30-minute chart. Market was very bullish. Suddenly any news came in, economic, you can check out economic calendar. Any news came in the US session, and market suddenly dropped aggressively, and you see every ultra high volume on every candle. Check it out. Ultra high volume on this candle as well, ultra high volume on this candle sell candle as well, ultra high volume on this sell candle as well, ultra high volume on this candle. It means that smart money is actually active and buying on every possible move to the downside, because smart money is aggressively buying here on whole move drop. Like previously we saw the setups of one candle setup, or two candle setup, or three candle setups. Now on this setup, market actually buy on whole range, whole price range. On every buy candle, the big players are actually injecting their buy positions and going against the dues and against the retail traders. Now at one stage they enough bought that market stopped and start going up. Don't buy straight away. Just wait for the low volume buy candle. If low volume came in, that's okay. If low volume is not coming, then wait for the range. If market start ranging with the low volume and start drifting upside, just buy it. Place stop loss below and just get 1:3, 1:4, 1:5 accordingly. That's it. That's the strategy. Okay. Again, market was going up, and suddenly there was a news came in, and market start having a ultra high volume on all sell candles. Market tested the previous support, and then market start going up. Then a tight range formed. When that happens, you should have your mind that it's confirmed that now market is converted from buying to selling. The buying from the players is enough that now trend is changed, and now supply is being removed and demand is overcoming supply. And now any breakout, low volume breakout, is a sign of strength, and you should buy there. You should place stop loss below that, and you should expect 1:4, 1:5, 1:3 from there here on. Again, there is a resistance. This is a Bitcoin chart, 1 hourly chart. There is a resistance to the left. Market start going up with the ultra high volume. There's an ultra high volume on all buy candles, even sell or buy candles. There are ultra high volume on all this range. Look at this, and this is actually breaking out. Any activity, any candles which is breaking out or breaking down with ultra high volume is fake out. And then market start dropping back with the low volume, and then the market start ranging tight range with the low volume tight range. Then you should just sell below the range. Whenever market go below this range, sell it, place stop loss above this range, and just get 1:3, 1:4, 1:5 profits. That's very important. Again, this is a crude oil chart, 50-minute chart. Market is coming down on every possible sell candle, ultra high volume coming in. That means players are active from start of the move. Players are buying, but the retail sellers are very panicked. They are selling, and the player is buying on the lower rates. So at a time come when players bought so much that market stopped. Market when stopped, then market start reversing upside. If their volume is low, then you should take a buy trade here, and don't wait for this range. And if you did not bought at this place and you saw this range, then buy again here. When range breakouts, then buy again here. This is your second entry, this is your first entry. So you can have two entry in this setup as well. So this whole range was actually happened when there was a bad news, heavy volumes on all sell candles. There was a professional big players, big smart money was buying, retail traders were selling, and a time comes when selling was dried, supply was almost over, and now demand is overruling the oil. And now this activity is actually saw by the market maker as well. So they actually removed their liquidity of sell liquidity. So market turned up, then market started ranging with low volume. That also confirmed that this whole scenario of drop is actually the result of more buying than selling. Now you should expect higher prices, and when market start breakout this range, just buy there and place stop loss below and expect 1:3, 1:4, 1:5. Again, this is a British pound, 1 hourly chart. So look at the volume on all 5 candles, 1 2 3 4 5 on 5 candles. Market have ultra high volume. Look at the volume, ultra high volume. Then market reversed back on a low volume. You can buy there as well, but you have to wait for the range. If range came in, you should highlight this range, and whenever market break out this range with low volume, just buy it and place stop loss below, and just expect 1:3, 1:4, 1:5, whatever you want. You can expect that after that. Okay, so this is the trading strategy, very clear. Ultra high volume on whole drop, or ultra high volume on whole jump, and then there is a range, and then breakout of range should be your entry. Okay, Again, this is a British pound chart, 30-minute chart. There is a resistance left to the downside. Then suddenly a news came in. Market starts going up very aggressively. Very aggressively market jump upside, and ultra high volume is coming on all buy candle. That means the market is not strong. Market is weak because big players are active here and they are selling on these buy candles, and then market stopped and start ranging. When market start ranging above near this area, you should place this box in this range, and when market starts breaking below this box, then sell this trade, sell here, place stop loss above, and this expect 1:2, 1:3, 1:5, 1:10, even risk to reward ratio. Okay, so that's your sell scenario. Okay, train your eyes on these charts and just print it out and put in front of you, so you can train your eyes on these setups, and this will give you a lot of money. Again, British pound 15-minute chart, there's a resistance to the left side, market start going up, market have a ultra high volume on all buy candles, 1 2 3 4 5, on all 5 buy candles. Then market start going down with a low volume. You can sell there as well, but if you saw a trading range near that territory where ultra high volume coming in, then you should place that range with a highlighted box. Whenever market start breaking below that box, sell it, place stop loss above, and you should expect 1:4, 1:5, 1:6 from here on. Okay, again, this is a USD CAD chart, a 30-minute chart. Market was very bullish. Suddenly some news came in, then market started going up. On every buy candle there was a ultra high volume. Look at the candle, high candle, very big candle, then small candle, then small candle, then small candle, then small candle. Means the momentum is losing, market is losing momentum, and the player is actually selling so much that candle is now started shrinking time by time. Now our time came in when market become tired and now start ranging. When market start ranging, you place the range, and when this range breakouts below, then sell it, place stop loss above, and then get 1:3, 1:4, whatever as per your risk appetite. This is the USD CAD chart, 15-minute chart. Market was bullish, then market suddenly came down as a shakeout. Market on every sell candle, possibly 4 to 5 candle, there was an ultra high volume which is bigger than previous all volumes. These ultra high volumes, then market wait for market to go up. Market start ranging with a wide volume, then wait for one candle to close above this trading range with the low volume, and that where candle came in. You just need to buy on this breakout and place stop loss below, and just expect 1:3, 1:4 accordingly. This is a USD CAD 5-minute chart. Again, market was going up, then market start dropping on every candle. This on this drop, and every single candle, whether buy or sell, got the ultra high volume. Now market start going up, wait for the range, where range came in, very big range came in. Then market start jump above that range. You can buy here as well, then place stop loss below. Then market again come to the range, then market again breakout. You can place second buy here, you can place stop loss below, and you can expect 1:3, 1:4, 1:5 easily. This is a 5-minute chart, and look at this. If you buy at 1.4330, your stop loss will be 1.4310. So your stop loss will be just 20 to 15 pips, and you got almost a move of 60 pips, 70 pips. So that's very easily you get. Okay, by this strategy. Just understand this strategy, just train your eyes, and you will get a lot of such scenarios in the market, and you just kill the market. Again, this is a USD JPY chart, one hourly chart. Market is coming down on this, or there was a support, previously support, and market again dropped and retested that support as a double top bottom. And on this retest, market have all ultra high volume on this retest, and then market jumped up with a low volume. You just buy there. If you are not buying there, then wait for the range came in. When range came in, you just need to wait for one bullish candle to close above that range. If that one candle came in, you just need to buy there, and you should place stop loss below, and you should expect 1:4, 1:5, and so on. This is the USD JPY chart, 30-minute chart. There is a resistance left to the left. Market, there was a some very good news came in. Market spike up. There was a ultra high volume. Then market got 2 to 3 buy candles. All candles were getting ultra high volume. So that breakout was a fake out, because good news was good, but the ultra high volume breakout is always a fake out. So when after that market start ranging, you plot the range, and when market break below that range, you just sell it, place stop loss above that, and you should expect 1:4, 1:5, 1:10 even on those trades. Okay, look at the volume is dried in this range. That means that the buying pressure is over. This selling from the big player is enough to stop this uptrend, and now sellers are dominating the market, and now market makers actually saw the situation. Now market makers are not coming in front of this drop. They are not providing the buy liquidity. They are not providing the buy liquidity here, and they are because they know that market price will be lower, and they will get low rates to provide the buy liquidity. So they reacted as per the conditions. So that is why market coming down. Again, this is a chart of Australian dollar, 30-minute chart. There is a ultra high volume to the left, and the market stop goes down. This was the resistance. Then market retested that resistance, and there was a ultra high volume on all candles. And again there was ultra high volume on all candles. Then the small range came, and you should place that range bound. Came, then gap came out. Whenever market gap below this range, just sell it, place stop loss above, and just expect 1:3, 1:5 after that. So that's a very simple strategy. Just you need to mark the ultra high volume area, and then a range bound, and just wait for range bound breakout to the opposite side of the move. If buying ultra high volumes were in the buy side, ultra high volume on buy candles, then range breakout must be on lower side, because we are going against this upside retailers. So retailers were buyers here, so big players were selling at this place, and the range came in suggesting that the trend is now transformed from buying to selling, because range was evident here. So whenever market breaks below, sell there, stop loss above, and thus enjoy the music of the downside market moves. So, like on all situations, there was a range where market ultra volume on all buy candle sell candles, and then markets reversed back, and then got the range range breakout, buyer, place stop loss below, expect 1:3. Again there was a market were dropping on ultra volume on every candle. You should label it as ultra high volume area, and then wait for the ultra high volume range that came in. That means that buying pressure is over, selling pressure is over, and now market is ready to go up. You just need to buy on breakout of this range with the low volume. So again aggressive selling came in, and the big players were buying in this aggressive selling, and then so trend stop in, and then you got the range. You wait for the breakout of this range with low volume, just buy it. Again there was a good news, market suddenly goes up. You wait for the market to turn back, market turned back, then market start ranging. Wait, label this range, and when market close below this range with low volume, just sell it, and you should expect 1:3, 1:4, 1:5. Like if you sold at 1.4431, then you have stop loss of just 10 pip, and you got the 1:3, 1:2 easily. Again there was a resistance to the left side, and this strategy came in exactly at the bottom top of near to the resistance. That's very important. And ultra high volume on all buy candles, then wait for the market to turn. If market turning back with low volume, then sell immediately. If market not turning and just ranging it out, then highlight this range and then wait for market to close below this range. If market closing below this range with low volume, then sell it, place stop loss above, and just expect lower prices. This is also very easy. Market suddenly go jump up with the ultra high volume, means there is a selling. Was a selling. Wait for the market to turn back. Market did not turn back. In fact, form the range above, near above the ultra high volume scenario. And whenever market break this range with low volume to the down, then you have to sell there, place stop loss above, and expect 1:3, 1:5, 1:6 activity. So that's it. That's a simple strategy. If you don't have a confusion in that, I am giving you an email in my description. You will just send me email, and also mention your phone number in that email so I can contact you on WhatsApp, and I will help you every matter you question you got regarding this strategy. Okay, thank you.